There's no CNN headline that says, "Hey everyone, start selling. We're about to lose half our money." Not at all. Crashes show up like that one friend who never knocks. They just walk in, eat your food, and destroy your peace. Welcome back to the Financial Watchman, keeping guard over your dollars so you can sleep at night. Today we're diving into how financial crashes actually happen, why they keep repeating, and what one might look like today in 2025. And more importantly, how you can prepare so the next crash doesn't wipe you out like a rookie trader in 1929. Now buckle up, because we're taking a ride through the financial roller coaster of history, and we might even laugh through the pain. So what exactly is a financial crisis? Let's simplify this. A financial crisis is what happens when confidence, the invisible glue that holds the entire money system together, breaks down. People stop trusting, banks stop lending, and investors stop believing in numbers going up. In regular life, it's when you realize your paycheck can't keep up with your bills. In finance, it's when the entire economy realizes that. The result? Falling asset prices, panic selling, layoffs, and headlines like "worst day since," which by the way the news loves saying. What about history's greatest financial meltdowns? Let's stroll through memory lane, aka the graveyard of bad economic decisions. The Great Depression, 1929. People were buying stocks like they were Pokemon cards and borrowing money to do it. When prices stopped rising, margin calls hit, panic spread, and boom, the market dropped 90%. Banks failed, unemployment soared, and the government learned the hard way that markets don't fix themselves whenever everyone's broke. And the lesson here, leverage or debt is great until it isn't. Let's get into Y2K, the dot-com bubble in 2000. Everyone thought the internet would make them rich overnight. You've got mail? More like you've got margin calls. Back then, if you slapped .com at the end of your company name, investors threw cash at you like it was Coachella tickets. The problem, most of these companies didn't actually make money. They had no business model, no profit, just vibes and PowerPoints. Like what the hell? Take pets.com. They sold pet food online, spent millions on advertising, including a Super Bowl ad. They also lost money on every bag they shipped. Their sock puppet mascot was adorable, but he couldn't pay the bills. When the hype died down, investors realized they've been holding fairy dust. The Nasdaq, which was full of tech stocks, fell nearly 80%. What's the lesson? Innovation is great, but eventually somebody has to make a profit. Hope does not pay dividends. And then we get to the 2008 housing crisis, where houses played Jenga. Yes, 2008. The year when the American dream turned into the American foreclose and move back with your mom. Here's how it happened simplified. Banks started handing out subprime loans, mortgages to people with low credit and low income because housing prices seemed unstoppable. And then came the sneaky ones, adjustable rate mortgages or ARMs. These looked friendly, low interest rates at first, like a teaser on Netflix, but after a couple years, the rates adjusted and usually that meant skyrocketed. Imagine paying $1,200 a month for your mortgage in 2006, and suddenly in 2008, it jumps to $2,200. That's like ordering a pizza and getting billed for a Tesla. Like what the? Anyways, when those rates reset, millions of homeowners couldn't afford payments. They defaulted, foreclosures exploded, and housing prices crashed. But wait, the bank didn't just hold those loans. They bundled them up into complex investments called mortgage-backed securities, or MBS. I'm sure you guys have heard about them. These were sold to investors who all thought they were safe. So when homeowners started defaulting, the entire global financial system caught a cold. Except this cold came with pneumonia and a $700 billion bailout. And the lesson here, never buy what you don't understand, especially when Wall Street does understand it and sells you it anyway. They literally built a financial bomb, called it innovative, and were shocked when it exploded. It's like inventing a flamethrower and then not thinking that it could burn down the whole neighborhood. But the question is, could it happen again in 2025? Fast forward to 2025. We've got record national debt, stock prices higher than Snoop Dogg on 420, and housing prices that make you question your career choices. But let's talk causes, not politics, just pure money mechanics. Here are some realistic current day triggers that could cause a future crash. Number 1, corporate debt overload. Many companies have been living on cheap debt since 2020. Now that the rates are higher, refinancing that debt is like going from a $99 lease to a $499 car payment. If profits dip, companies could default, leading to layoffs and market fear. Number 2, consumer strain. Credit card debt is at record highs. Savings from the pandemic era are mostly gone. If jobs tighten and costs rise again, defaults and spending cuts could hit the economy hard. Number 3, the housing affordability crisis. Sound familiar? Home prices are up, mortgage rates are up, and incomes didn't exactly double. That's a recipe for stagnation or correction, not a 2008 repeat, but possibly a painful slowdown. Number 4, you guessed it, tech and AI overvaluation. AI stocks are booming, and some deserve it, but others, they might be the new .coms, high on promise, short on profit. Remember when everyone said 3D TVs were the future? Yeah, how's your 3D remote doing right now? And number 5, last but certainly not least, a global confidence crack. A big geopolitical shock, a major cyber attack on financial systems, or a liquidity freeze could spook investors fast. The first domino might not even be in the US, but once fear spreads, the algorithmic traders finish the job in minutes. Hey, if you're still watching and haven't smashed your screen in panic, hit the like button, comment still keeping guard, and subscribe to Financial Watchman. It tells YouTube you like learning and laughing about money, not crying over it. Now let's talk survival mode. How do you protect yourself from the next crash? Because it's coming. Here's how to build a financial bunker without looking like you're prepping for the apocalypse. Diversify your portfolio. Don't go all on hype. Pick stocks for growth, bonds for stability, real estate for income, cash for opportunity, and gold for drama insurance. Think of it like your diet. You can't just eat crypto and call it balanced. Invest with a long-term vision. Buy companies that survive hard times like Coca-Cola, Apple, Johnson & Johnson. They've all lived through crashes, recessions, and memes. You're gonna wanna own assets with real utility and long-term staying power. Keep an emergency fund. 6 to 12 months of expenses minimum, because when markets crash, bills don't take a vacation. For the ones who thought they had their Robinhood account down to a science, do not over leverage. If you're using borrowed money to invest, you're not investing, you're gambling with a timer on it. Margin calls turn dreams into day jobs. Last but not least, and probably one of the most important, you have to manage your emotions. The biggest crash protection is emotional discipline. Everyone looks smart in a bull market. True investors earn their stripes when it's raining red. Remember, the market is like dating. If you chase it every time it ghosts you, you'll end up broke and embarrassed. If you're already in good companies and you have a strong belief in your thesis and the moat why you invested, sometimes the best decision is no decision. Leave it alone, set it and forget it. Let it live through the market crash. Let it live through the downturn. You got to manage your emotions. So if a crash hits tomorrow, who do you think will survive? It's gonna be those with cash flow. those who own real estate assets, those who stay calm when others panic, and those who didn't invest based on TikTok advice. And I'm gonna beat a dead horse here. It's not about timing the market, it's about time in the market, with a plan that assumes bad weather will come. As Warren Buffett says, only when the tide goes out do you discover who's been swimming naked. So yeah, you might want to wear your financial swimsuit. Listen, crashes are a part of the financial cycle. They cleanse, reset, and teach. Don't fear them, prepare for them. Remember, wealth isn't built in bull markets, it's protected in bear markets. Financial crashes is what differentiates the lucky from the disciplined. When the lucky is selling off at a terrible loss, the disciplined is deploying cash flow to gobble up great discounts. If this video made you laugh, learn, or both, hit that like button, subscribe, and if you want to fuel my caffeine addiction, support the channel by buying me a coffee at buymeacoffee.com/The Financial Watchman. Now tell me in the comments, if the market crashed tomorrow, what's your first move? This video is for educational and motivational purposes only and is not financial advice. Always do your own research or consult a licensed financial professional before making investment decisions. I am the Financial Watchman, keeping guard over your dollars so you can learn to guard your own. Stay sharp, stay prepared, and I'll see you in the next one. Bye-bye, y'all.